Good morning. Welcome to Stock Market Today. It's Friday, December 7th, 2018, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan_Russo_CMT. And if you're over on StockTwits, I am there as well under the same handle. Stock Market Today brought to you today and every day by Chaikin Analytics. And you can sign up for a free email, follow along with this show, and receive stock ideas. Head over to chaikinanalytics.com/today. So U.S. equities were mostly lower in Thursday's trading, but ended near their best levels of the day. Major markets closed down less than 50 basis points after a lot of them were down over 2% earlier in the day. And the NASDAQ actually finished higher on the day. Treasuries were stronger again, though with the curve steepening. The dollar was down on the major crosses. Gold finished up 10 basis points. Oil was weaker. WTI crude settles down 2.6%. Breadth on the New York Stock Exchange and NASDAQ both came in negative 1.6 to 1. Your outperforming groups were your REITs, comm services, consumer discretionary, and tech, while your underperformers were energy, financials, materials, and industrials. And as we get to the desk this morning, futures are down 40 basis points after that strong, after finishing lower yesterday, but having a big reversal. Asian markets were mostly higher overnight, with Japan leading. European equities are seeing good gains as well. Treasuries are mostly weaker following a big two-day rally, and the dollar is a bit firmer versus the yen, little changed against the euro. Gold is up 30 basis points. WTI crude is up 30 basis points as well, and investors await the non-farm payroll report, where consensus estimates are for a 198,000 job increase in November. So as we turn and look at the market here, here's the S&P 500. Here's that daily chart. You can see big reversal after testing support. Support down here in the 2630 area. Tested once again yesterday, and then markets promptly reversed and headed higher and closed near the highs of the day. As I said, S&P closed down, but the NASDAQ was actually higher. A lot of back and forth, a lot of volatility. To me, two numbers matter. 2630 to the downside, 2815 to the upside. That interim high at 2815 is the key level for the bulls, because we want to see confirmation of the two things we're going to discuss next. First, RSI makes another positive divergence, higher low here, and Chaikin money flow is bullish and remains bullish. So we have some positive indicators. Now we need confirmation from price. We want to see it break above that 2815 level to give us an indication that the bulls have taken control. That's the key level on the upside, 2630 to the downside. Now, our market in a minute. Here's what we're talking about in our note to Chaikin Analytics clients today. Stocks reverse steep losses to close near the highs of the day. We talked about that already. Small caps continue to lag. Large caps, that's a sign of risk off, in my opinion. High yield testing support relative to treasuries, another barometer of risk. We're going to take a look at that chart. 10-year yield falls below 2.9% as investors seek safety, and the home builders turn lower again. Now, our power bar ratios for the major markets remain skewed to the bearish side. The Dow, 4 bulls for 5 bears. S&P 500, 63 bullish or very bullish stocks for 88 bearish or very bearish stocks. NASDAQ, there's that NASDAQ closing higher on the day. 13 bulls to 18 bears. Small caps, an inline performer yesterday, but they've really been an underperformer. 172 bullish or very bullish stocks, 480 bearish or very bearish stocks. And you can see the sentiment here, right here. Bonds upticked, priced by 30 basis points, yields to go lower. And look at real estate on the day. Up 2.74%, 4 bullish or very bullish stocks for only 1 bearish or very bearish stocks in that real estate sector. So according to the Chaikin Power Bar, small cap stocks are more bearish than large cap stocks, but the major indexes are all bearish. Turning now to our stock of the day, and this is going to be more for illustrative purposes than anything else. Remember, the stock of the day is auto-generated. It's not picked by me. It's auto-generated based on our proprietary Chaikin Power Gauge rating. Investment Technology Group, ITG, closed up 10 basis points yesterday at 30.16, but this is a bit of a special situation as they are being bought, right? So, but again, we can use it for illustrative purposes prior to this gap higher on the breakout. Chaikin Power Gauge ratio, Power Gauge rating, rather, for investment technology group is very bullish due to attractive financial metrics, strong price volume activity, and positive expert activity. They did have weak earnings. And what we want to look at here is, look, you had a sideways stock for a while. Ratio, power bar, power gauge rating was mostly neutral. But then all of a sudden in late September, late September, it turned bullish. That's your first sign. Then in early October, it starts to outperform the market. Strong money flow. This personality change is what we're talking about, where we try to identify these as early as possible for emerging trends. Rating turned bullish, market and model became in agreement, stock moved higher, consolidated, and then they were taking out. I'm not saying that that's going to be the case all the time, but this is what we're talking about, and this is why we look at, both the power gauge rating in conjunction with relative strength, because we think that that could be a really strong indicator for positive catalysts and positive price performance down the line, and that positive is on a relative basis. In this case, it just happened to work out that they were taken out at a much higher price, but these are the setups that we like to look for. Turning now to our sector tracker, looking at the movement of the major sectors over the last 5 days, and the top two kind of tell the story. Risk off. Bond proxies as investors seek safety and as yields fall. Real estate up 2.83%, utilities up 2.61% over the last 5 days, and the counter trade to that has been the weakness in financials. If yields have collapsed, as the yield curve has, the 210 spread has tightened, the front of the yield curve has begun to invert. The financials have really come under pressure, down 4.66% over the past 5 days. Nice to see technology near the top of the list, as well as discretionary. We want to see if you're bullish, you want to see those two groups really leading. Staples in the top four, the defensive posture of the market. Near the bottom of the list, materials, energy, and industrials. Kind of paint the picture for what's going on in commodities, as well as some weakness that we're seeing around the globe. Now, our industry in focus today is pharmaceutical services, and this is why it's important to really drill down. We've been bullish on healthcare. Healthcare as a sector has been an outperformer. It's been leadership, but you really do need to be in the right parts of the market. Take it down another level. Once you've identified a strong sector, you want to identify the strong industry groups as well as the weak industry groups within those sectors, because if you were in pharmaceutical services, you wouldn't be enjoying the outperformance of overall technology, because pharma services over the past 6 months has underperformed the S&P 500 by 1.5%, and its power bar ratio, which measures future potential, is very weak. Again, this is how many stocks within this industry group Chaikin Analytics rates as bullish, neutral, and bearish, and you can see it's skewed massively to the bearish side. Group's currently ranked number 13 of 21 subsectors. It has moved up 1 slot over the past week, and some of the indicative, very bearish names in that group that we want to avoid, get out of the portfolio, or potentially look at opening positions to the bearish side of the trade are Areata Pharmaceuticals, RETA, Aerie Pharmaceuticals, AERI, and Medicines Company, MDCO, all with very bearish Chaikin power gauge ratings. So let's take a look at Medicines Company here today. Closed at 22.05, up 2.18% yesterday. However, its power gauge rating is very bearish. Weak trend, weak industry group. So at the very least, we know we don't want to own this stock. And if we're looking for bearish ideas, we're fishing in the right pond. Ribbon at the bottom of the screen tells us where that power gauge rating is and has been over the past year. And you can see we've been on that bearish rating since the end of August. And then in early September, again, what we were talking about, the market and the model got into agreement, and look at what happened ever since. Just a nice, steady downtrend. All right, so the market and model continue to be in gear, and look at the intensity of the underperformance relative to the SPY. It's not waning at all. Bearish money flow here as institutional investors are dumping the stock. But now with this little rally that we've had from below 20 back up to 22, we've created an overbought condition. That overbought condition sets the stage to enter a trade to the bearish side. MDCO, if you own it, I think this rally here is an opportunity for you to get it out of your portfolio. And if you're looking for positions on the bearish side of the coin, I think the setup here looks pretty compelling because we have a very bearish stock with a weak trend and a weak industry group underperforming the market, becomes overbought with bearish money flow below the falling long-term trend line. That is a great setup for a bearish trade. Take a look at ticker symbol MDCO for an opportunity to the bearish side. Now, turning now to yesterday's S&P 500 gainers and losers. Weyerhaeuser, WY, is actually part of the real estate group. I didn't see any company-specific news there, but as we saw, real estate names were strong yesterday. Weyerhaeuser up 6.45%. Hewlett-Packard Enterprises, bullish stock, HPE, up nearly 6.5% as the market liked what they had to say on earnings. Another real estate stock, Kimco, KIM, bullish rating, up 5.3%. Defensive posturing. We've been talking about it for a while. Utilities and real estate, not the most exciting parts of the market, but that's what's outperforming. And if you're following a process of identifying strong stocks in strong parts of the market, you're going to be drawn to the bullish and very bullish names in utilities and in real estate. I know that that's not super exciting, but what is super exciting is outperforming the market. So that's where we're going to focus. Take Two catches a little bit of a rebound here, up nearly 4.5%. And Discovery, DISCA, down sharply after some comments at an industry conference earlier in the week. Catches a little bit of a rebound here yesterday as it did see an upgrade from a sell-side research shop. That stock added 4%. Silicon Valley Bancorp, banks under pressure with the yield curve continuing to compress, down 8.8%. FTI, didn't really see any news there to send that stock lower, although it is levered to the energy complex, so weakness in oil continuing to weigh on the energy equities, down 7.7%. BHF down 7.7% as well. XEC and Concho, again, energy names coming under pressure. XEC down nearly 7%, and Concho CXO down nearly 6% as oil remains under pressure, and we didn't get a whole lot of clarity out of the OPEC meeting yesterday. So now let's turn to the key themes and trends that we're talking about today. There's that 10-year yield breaking below 2.9%. That's why your utilities are strong. That's why your real estate is strong, and that's why your financials are weak. TNX goes below the 200-day moving average, 50-day moving average beginning to round down. We took out support at 3%. We're now testing levels in the 2.85 to 2.9% area. And look at the RSI, massively oversold following this negative divergence. I wouldn't be surprised to see a little bit of a bounce here. Obviously, we're going to get the payrolls number today at 8:30. That's going to have an impact on yields, but just given oversold nature and near this cluster of support, I wouldn't be surprised to see us kind of rally to retest this 200-day moving average and broken support near 3%. High yield testing support versus the treasuries. This is the HYG high yield ETF relative to IEF, the 7 to 10 year treasury bond ETF. This, to me, is a sign of risk on, risk off. When high yield is outperforming treasuries, it's a sign of risk on sentiment in the marketplace. You can see we topped out in October and we've been going lower, took out the 200-day moving average, now testing support as we are near oversold levels for this ratio. Bullish investors want to see this support level hold and see this ratio begin to move higher to signal a willingness by market participants to take on risk. We're not seeing it yet, but if it's going to reverse, this support level would be a key spot from which to do so. Relative weakness in small caps continues. We've broken below support here. This is IWM relative to SPY. Takes out support, but what's interesting to me is the IWMs on a relative basis are holding, on an absolute basis rather, are holding up. Continued relative underperformance, though, puts that support level in the IWM at risk as far as I am concerned. If you're bullish, you want to see this reverse, and you want to see it reverse soon. Small caps continuing to underperform, and here are the home builders turning lower once again. Home builders, ETF XHB, neutral rating. It's overbought. It's been underperforming the market. Strong resistance in the 36 to 38 area here. I don't see a whole lot of reason to get excited about the home builders group just yet. So that's it for today. Sign up, chaikinanalytics.com/today to get daily stock ideas and to follow along with this show, I will see you back here on Monday.